This is a Brooklyn-bound 2 train. The next stop is
Wall Street.
Stand clear of the closing doors, please.
Welcome back. This is Not Your Advisor with NYU Grad on Wednesday, May 14th. Let's jump right into today's session. It was a below average affair, but for the first time in history, mom and pop have outsmarted Wall Street. Per Bank of America, there is a chart that shows hedge fund and institutional flows versus mom and pop. And mom and pop is piling in. Meanwhile, if you take a look at credit spreads, there's no fear. Credit spreads have been smashed lower right now. It's just risk on with below average volume. Let's take a quick look at breadth numbers right now. On the NYSE, we had 320 new highs, very bullish, versus 178 new lows. 34% advancing versus 63% declining on the session. 34% below the 50 and 55% below its 200-day moving average. The NASDAQ closed up 0.75%. The S&P pretty much a nothing burger, up 6 points or 0.1%. Looking across the board at the Mag 7, it was a mixed bag. Tesla was up 4%. Google was up 3.6%. NVIDIA up 4%. But Apple was red, down 0.28%. Amazon down 0.58%. And Microsoft was up marginally 0.85%. Taking a quick read on sector analysis, you had communication services up 1.3%. Technology was up 0.8%. Consumer cyclical up 0.34%. Everything else was pretty much red. You had healthcare down a whopping 2%, continuation from the remainder of the week. Basic materials down 1.3%, real estate down almost 1%, utilities down 0.4%, along with energy. Industrials down 0.25%, with consumer defensive being down 0.21%. Financials pretty much break-even day, but down 0.12%. What else kind of stood out to me here? Outside of the fact that mom and pop is outsmarting Wall Street, the below average flows and volume still remains a concern for me. We obviously are furiously rallying here. Couple thoughts. So if you've been following me a long time, you know that I'm not a perma bull or a perma bear. I try to be balanced in my analysis. But I'm going to just put this out there. If I were personally retiring this year, next year, I would be enjoying this rally and selling a lot of my risk assets into this rally and transitioning to much more of a safety position, because I think that this is a gift. When you look at the next, let's say, 10 years, I think for longer term investors, there will be a time to buy lower. But right now, we're in this short covering, FOMO, late stage, mom and pop buying frenzy. And I suspect that the big money is going to be selling. I could be completely wrong, but you show me sessions where we have 2.5 times average daily volume on the upside, other than the whole Liberation Day reversal, cancellation, like, oh, I'm just kidding, we're not going to do tariffs anymore, blah, 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 blah. Like, other than that day where we reversed and made an interim low, show me up days with heavy volume. It's very hard to find. And when I asked, show me down days where we have crazy volume, they're plentiful.
We can't forget that this is just a small taste of the in-depth analysis that Not Your Advisor provides. They don't just throw numbers at you. They connect the dots, find those hidden trends, and help you understand what's driving the markets.
If you want the full picture, you got to check out the full Not Your Advisor episode.
Don't forget to subscribe to notyouradvisor.com.
And all their premium content. I mean, it's like having a direct line to what's really going on in the market.
It is. It really is. They cut through all the BS and give you the kind of info that you just won't find anywhere else.
Think about this. Investing is all about making decisions that work for you and your goals. You're the one in control.
Not your advisor can give you the map, but you choose where you want to go.
And with that empowering thought, we'll sign off. Happy investing.
Stand clear of the closing doors, please.